Hello, everyone. My name is Robin Dolezal. Today is Wednesday, March 22nd. With me, as always, are my colleagues Alex Pars and Dan Nentel. Together, we are with Ironwood Financial. Good to see you two.
Nice
Good to see
rainy
you
day.
guys.
Yeah, man, we just got poured on rain-wise.
Yep.
Sheets.
Yeah, I just got an email during this video that lacrosse practice is canceled, in case you were worried.
Good news. Good news. Just keeps rolling in.
So what's funny is I've got two young boys. They're God, what are they, 7 and 9 now, and they have tennis lessons 2 days a week. And I'll tell you, Dan, every single day we go to tennis and go, is tennis canceled? Is tennis canceled? It's beautiful out. And then today they're probably like, tennis canceled? Well, it's not today anyway. So anyway, well, great to see you guys. Obviously, we waited to have our meeting until the Fed spoke, and they did. And so we've got that going on. We obviously want to talk about the market a little bit. I know, Dan, you wanted to start off. I think we did this, 3 weeks ago? I think the 9th of March was our last one. And I don't think the markets have moved tremendously much from there, but give us your insight. What's going on?
Well, we did do a market recap that Alex wrote, when we started seeing those, the cheater banks, if you will, get caught with their hand in the cookie jar and put the world into kind of a frenzy with the banking crisis. Reality is the banking crisis is probably what changed the outlook for Fed meeting today. I mean, I know I personally was very much so looking forward to the Fed saying, what they kind of said, which is let's raise it 25 basis points to a Fed funds rate of 5%, and let's take a breather and see where we're sitting, right? Because you kept hearing for months and months and months, did they overdo it, and is there a crash landing, or are we going to land perfectly? And we've never been too overly concerned because our thought is if they overdid it, they would actually lower interest rates. But unfortunately, we've been living in this world of bad news is good news. If people are having credit card debt, that's good. Inflation is going to hit. If people are getting foreclosed on their cars, that's good news. That means inflation is going to slow down, and we need pain. And we had pain. Unfortunately, we had these banks that were doing some things that maybe weren't as prudent as they should have been. And the pain became a little bit more than we could bear. And now we all decided, at least Alex and I were looking this morning, everyone wanted us to do a rate decrease today. But inflation hasn't really subsided yet. So there's no reason for the Fed to actually worry about that. And they probably did exactly what they're supposed to. But the markets wanted a decrease, which obviously means the cost of money is less expensive. And hopefully the the cost of borrowing is less, which means their profits should be greater. I don't know that to put it in perspective, there's still some parts of the market that are priced very well. You can still get 5% CDs on a short-term basis of 3%. Yields on bonds have gone up. I just looked. You can do a 3-year bond ladder paying all darn near 7% using high quality and some high yield. And I don't know that what they said today really changes anything. I wouldn't be surprised. Alex and I had a meeting this morning, and I hope this doesn't offend anyone, but you don't hear people talking about the war in Ukraine very often. Obviously, China visited Russia last week, some talk about peace, but you don't hear about it like we did a year and a half ago when oil prices skyrocketed. We're now hearing people, should I be buying gold? Well, gold was pretty sexy for a bit because we were worried about a run on the bank. But now that seems to, Janet Yellen has told us not to worry, and we're seeing gold subside. I don't know that what's happened changed anything. The summer is probably going to be volatile. And as the Fed says we're going to stop raising rates, we should probably see some optimism. And the great part for our portfolios, and we've been telling everyone, we've been using a more aggressive stance. This will still give us the opportunity when we get a rally, which most people think we will. Is that this summer? Is it this fall? I don't know, but that gives us opportunity to become more conservative. So I'm not certain today changed anything. Alex, I'd like to hear your opinions on looking at it from a more of an economic standpoint, but
There was nothing surprising today. This is, again, people nitpicking over the verbiage. So what were we expecting? We were expecting a 0.25 rate hike, and we were expecting to say, don't worry about the banking sector, right? The banks are fine. That's what he did. I mean, and we've seen every time there's a bank come out with trouble, well, it's taken care of, so you don't need to worry about that. So Yellen is taking care of it, or the Swiss, or you name it. The thing that was, interesting about that rate hike that I think was kind of cool was, if they were really worried about the banking sector, there's no way they would have raised rates.
Right.
Right? They would have either
good way to look
paused.
at it.
Yeah, or lowered it. So them saying, hey, no, this is fine. Don't worry about it. We're still going to go on. They're more worried about inflation than a banking crisis. Okay, now if you put those two things together and you say a little bit of inflation or a banking crisis, I can tell you which one worries me more. But they're
Right.
saying that's so far out in left field, we don't even need to worry about it. Or is it right field? I'm not sure which. So
Well,
I think
it's so funny, Alex, because the market was relatively flat all day, right? As before the Fed spoke, and then they came out and they said we're going to raise rates, and and everyone read what they had said. The market was still flat. It always comes to that press conference, where you
yeah.
can really kind of read between the lines on how he feels, and then by the end of the day, the market had kind of fallen off a little bit.
Right.
Um,
And there were two statements in there that were really important. So the first statement was they got rid of ongoing rate hikes. That's what they've been saying, to something along the lines of we might need to do something more, maybe. Okay. So that was obviously what we were looking for. That's that pause that we've been talking about, saying, hey, let's see what damage we've already caused, and before we just keep, pounding on the interest rates. The part that I think upset people was when he said, and I'm paraphrasing here, of course, but he said, we don't know what to do if inflation gets out of control. So if these inflation expectations get built in, people start acting like it's always going to be inflation, and that's really hard to control. Okay. But, if we get an economic turn down, we know how to fix that. Okay. So what that was a very hawkish tone of, we will stomp on inflation. If we cause a recession, well, we'll get through that, no problem. Okay, but we don't want inflation to get out of control. Again, good policy moves, but that definitely leans more towards more rate hikes as opposed to fewer, or more hawkish tone. So I think that's what really upset the markets. But it wasn't an earth-shattering thing. I wouldn't be surprised if the market downturn today, which erased some of what we gained in the last 2 days, is short-lived. I mean, after this, it's back to business as usual. Nothing, as Dan said, has really changed.
It was funny. I don't know if you guys listened to the actual press conference part, but someone asked, gosh, last time it seemed like I'm looking at the notes, you had used the word disinflation 12 different times, and I haven't heard that today. And, and Fed Powell's like, well, that's because you asked the same question 12 times.
By the way, just as a side note, for those that don't know, if you're hawkish, that means you're continuing raising interest rates. If you're dovish, that means you're going to start lowering interest rates. And I don't know that I would have taken out of this that they were hawkish or that they're going to raise interest rates, but it is interesting. I was making that analogy about the Ukraine, but you notice this, we tend to get all worked up, then we forget about it, and the market goes up, and then we get worked up because they're about to speak. And that'll happen a couple more times until they said, we're done. And we're going to take a little pause. So again, I don't think that, to reiterate what we've said, there's nothing really that happened earth-shattering. Long-term bonds actually got a little bit of a boost. Short-term treasuries have fallen below 5%, but CDs are above 5%. So there's still opportunity.
Yeah, another key takeaway is they didn't raise their target rate. So they're still looking at the same number. So historically, when people freaked out, it's, oh, not only did they say they're doing it today, but they say they're going to do it in the future. They didn't this time. They said, let's see what happens. So it could be that at the next meeting, they don't actually raise rates. And that's really the first time in a while that that's a reasonable possibility.
So that's what, May 1st?
6 weeks from now or so.
Yeah, so let's see, May 2nd, I think, is the next time they meet.
Gotcha. The bummer about that is we'll finally get some optimism that they're done kind of slowing down the economy, done making the money so expensive. Mortgage rates should come down, and then we hit the summer and everyone goes on vacation. So,
yeah.
Oh.
Yeah, mortgages are down full 0.5% from where they were, I think. I mean, I guess it's still not great mortgage rates, but
Well, I thought they fell down to like 5.9 for a little bit.
oh wow.
Yeah, I was back in January or December, I think. I know about a week ago they were at 7.05 was
That's right. They did jump with the banking crisis. Yep.
Yeah.
I know there was one thing we wanted to talk about because we had someone ask us this. Alex, this will be to you. Can you explain? Someone came into our office and asking about an annuity possibility with what, a 35% bonus? Alex, can you explain to us why that's smoke and mirrors?
Well, I mean, I'm sure it's legit. 35% from an insurance company for free. I mean, that's what those guys do. They just write checks. Um, I mean, bottom line, it's, as we said, interest rates there right now are the best they've been in years. They're 5% on short-term stuff, 7, 9% on high yield stuff. And yet an insurance company is going to give you 35% upfront. Okay. Does any of that sound weird to you? Again, they'll give it to you, but you can't take it out. Okay, there's an old Dilbert cartoon, the same thing. The perpetual investment fund, guaranteed 20% return per year, never have your money back. But we'll put it on a piece of paper so it looks like you're doing well.
Right.
The insurance companies have found a way to do that by using living riders, where they can promise whatever rate they want up front. All you have to do is lower the amount that you're allowed to withdraw for life at the end, and you can make the math work. So I could show you an annuity, or I could make one up that pays you a 50% bonus. All I have to do is take it off the back end. You're still not earning any more than you were before. It just sounds really cool.
So Alex, just so I'm on the same page, if I invested 100 grand and I get a 35% bonus years down the road, I can't take my 135 that I originally invested?
No, and chances are they'll tell you your 135 is worth 250 or 300 or whatever it is. Okay. But you say, give me my 250 tomorrow. They'll say, yeah, no, it doesn't work that way. You can take it out over your lifespan at a tune of, call it 4% per year. Okay. So if they hadn't given you that bonus, maybe they'd let you take it out at 5% per year. Okay. Well,
Yeah.
now you've got, 20% more money, but you can take it out 20%, slower. So they really aren't giving you anything different. It's just playing with numbers. Anyway, happy to run the spreadsheets. If you run across something like that, let us know. They're quite clever. Whoever developed those came up with that idea probably about 15 years ago. Pure genius. Hopefully they got lots of bonuses, because those things have been selling like hotcakes for decades.
One thing to keep in mind, and that is true, Alex actually built an algorithm that shows you what your true rate of return is by getting any bonus you want. And I've seen him run a 50% bonus and show you how they take it back in the long run. Now, one thing to keep in mind, just for those people that have purchased it, it normally uses a chassis. The underlying asset is what's called an equity indexed annuity, which does protect you against any loss. It does limit your upside, because obviously you can't have all of everything. So if you can't lose money, then you can't really grow very quickly. And that's why they have those bonuses. But for peace of mind, those people that have purchased it, you can't lose any money, but you're just never really going to grow.
Much. You will grow, but anyway.
Okay, so last thing, Alex, what do you got on your little tickler of what's coming out as far as data? Anything interesting coming out this week or the next couple weeks?
I mean, it's the same stuff that we've been watching. I mean, the Fed made it clear once again that their number one priority is inflation. They don't care about this banking crisis nonsense. So to me, it's still the jobs data. We're at, what was it, 10.5 million available jobs still,
Yeah.
10.6. That's way too many. We need to either fill those jobs or make them go away. We don't want to have any open jobs.
I was reading, just trying to get as much from the Fed meetings. I had a bunch of meetings today and I didn't get to read the notes, but it sounds like they're expecting inflation to kind of stick around for a longer period of time at a higher rate. So obviously they don't expect that 10 million non-farm jobs data or opening to go down very rapidly.
Well, every time they've been meeting, they've basically been raising those targets. They've been saying, oops, didn't do enough. We need to do more. So they've been, increasing the expected unemployment rate and decreasing the growth rate and increasing the inflation rate for the year. Okay, so they remember initially said this is going to be transitory. By the end of 22, it's going to be 2 or 3%. Well, that didn't happen. And now it's still higher than we want it to be. So that changes your average and your expectation for where it'll be at the end of the year. But that's not interesting one way or another. It's like saying, hey, we need to cut 10% off this. And we only cut 5% last month. So now my future expectation is, 5% higher. So that's nothing significant. But
Gotcha. All right. Well, thank you, boys. Folks, if you've missed any of our other discussions or videos, you can find them on our Facebook, I believe. If you've any questions that we did not hit on today, please feel free to reach out to us. You can find us at ironwoodfinancial.com, or you can call us at 888-271-4646. Other than that, gentlemen, I appreciate your time today. Good to see you, and we will see you guys again soon.
yeah, take care.
You guys.